So John, thank you for joining us today. We've had a lot of data over the last month or so. Up until a couple of months ago, the markets seemed to be pricing in a May rate hike at the Bank of England. Certainly that's changed in the last month. What do you make of the recent data?
Well, I was with the Hawks last month, and I think I'll stick with them this month. But I think the data will have changed the options here. I'm not expecting the MPC to raise rates this week. We've had a relatively weak growth figure. We've had a relatively better inflation figure than expected. I expect the majority to stick with no change.
And do you think the pressure overall on the Bank of England has eased to raise interest rates? Do you think maybe there'll be a change in the voting dynamics on the MPC?
Well, I guess the question now is, does the 3 remain 3 in the raise camp, or does it shift back to 2 more than will a majority join them? But obviously the pressure has gone down because the Q1 figure was a bit disappointing. However, my own view is that doesn't really change the nature of the debate fundamentally. There were special factors at work in the Q1 figure, just as in the Q4 figure. Yes, the inflation figure was better than people thought, but it's still 4%, and oil prices, of course, are higher than the bank was anticipating in its last forecast. So there's, as usual, there are things pointing in both directions.
So you still support a raise in the Bank of England interest rates. When do you think that might happen? Or when would you vote this month for a rate rise?
Well, I've said I would have voted last month for a rise, and I think I'd hold to that this time. The Q1 figures haven't really changed that view. I think everyone is in favour of a very loose monetary policy. The question is, at what point do you move away from the crisis levels of interest rates and QE that were established in 2009 at the depth of the recession, when the priority was to prevent the economy tumbling into a long-lasting depression. My view is that 2 years on, actually we see signs that there is growth, not exciting growth, not as high as we'd like it, but there is growth here, and that the world context is benign, with growth in America, Europe, as well as in the Far East. And in these circumstances, it's time to begin to make the move towards normal policy.
Is one of the reasons why you support higher interest rates because of second round effects? Are you worried about second round effects, pay settlements going up, inflation expectations going up?
Well, pay, of course, has been remarkably benign, and that is the main, if you like, dovish argument. I think we've got very limited information about inflation expectations, and I think it's dangerous to wait for inflation expectations to rise before you take action. And undoubtedly, if we continue to have, as we're likely to, inflation 4% plus over a year and well above target for several years, that is likely to affect price setters as well as wage setters.
Andrew Sentence, of course, who's leaving this month, he has said that he's worried that the credibility of the Bank of England may be called into question if they wait longer to raise interest rates. Is that a concern of yours?
Well, it's something that the bank needs to be very concerned about. Credibility isn't just a nice to have, it's a key policy tool. The belief that the bank will keep inflation low and around target over the long term is itself one of the things that keeps it low. So I know that the MPC, and not just Andrew Sentence, will be very concerned about that, and always is. I don't think there's any short-term risk to the credibility of the bank. I think it's come through this crisis with its credibility intact. But of course, you're only as good as your next game.
What are you expecting from this month's inflation report? Do you think the Bank of England will be forced to downgrade their growth expectations?
Well, I think that everyone has been lowering growth expectations in 2011. I expect we'll see some of that. The first quarter figure was certainly lower than they had penciled in the February forecast. So yes, I'd expect to see some shaving down on that.
And do you think with those lower growth expectations the economy is strong enough to withstand interest rate rises?
Well, this is this is the key decision, and it's really a decision about how far the household sector in particular will be weighed down by the burden of debt. And my view is that a modest beginning of a rise would be bearable and would not derail the recovery. But all the participants in this debate are talking about interest rates in the next few months at historically exceptionally low levels. I mean, we are at the lowest level of interest rates for 300 years. So of official rates anyway. So we're talking about marginal changes on that and moving back towards the bottom of what would be considered a normal range of interest rates, which I guess might run from sort of 2 to 6%, somewhere in that range. So no one's trying to sort of put in place a restrictive monetary stance.
I mean, you support higher rates, but what would you like the interest rate to be by the end of this year or by the end of 2012? I mean, no more than maybe 2.5% or around there?
I'm not going to make forecasts about what I'd be voting in the future. What you've got to remember in economic forecasting and assessment is that there are always more plausible accounts of where we are now than can be true. You've got to remain sensitive to what actually happens, and whether or not further interest rate rises are required in the autumn, we'll have to look at then.